Okay. It's so loud, everyone can hear the conversations.
He has the power. Put on speaker, that's why. Text Jubin.
Is he coming? No.
Did you know?
Call him. You ask me.
Good evening, everyone. Welcome to Team Patat Group First Quarter 2024 Analyst Briefing. This is Peter from Investor Relations. So today, our corporate representative, Mr. Hao Kim Lian, and a couple members from the senior management team will go through the presentation. During the presentation, please keep your line muted. And after the presentation, there will be a Q&A session. So with that, I'm going to bring out Mr. Hao for his presentation.
Hi, good evening, everyone. So, without further ado, I just start my presentations. If you do have any questions, I think do raise your hand and we will address it towards the end of the presentations. Okay, first of all, let's go through the result in first quarter 2024. I think you will notice that basically our insurance revenue basically have actually lower by about 22%. Predominantly, that was the effect of the gradual exit from commercial business. In 1Q23, there was still some carryover commercial business, I think from FY 2022, that actually was earned actually in 1Q 2023. Predominantly, the reduction in insurance revenue was attributable to the exit from commercial book. If we were to look at NWP of the group, basically year-on-year NWP of the group actually would have grown by approximately 18% compared to 1Q23. In 1Q23, also benefited from some reserve releases, I think from Tenang PA and also Motor carry forward from FY 2022. Excluding this one-off impact, the increase in net claims and other expenses actually was moderated, I think, to approximately 7.5. We were to compare 1Q24 to 1Q23. Instead of 18.8% increase, actually, the normalized position will be an increase of 7.5%. Mainly attributable to the increase in motor weightage in the overall business mix of our portfolio. The third area basically that may actually trigger some attention will be a significant reduction in our reinsurance cost, insurance premium cost by approximately 58.7%. Again, that was actually in line with the decision to exit from commercial business since I think 2022. Hence, the reduction in the insurance revenue, you probably have to view it hand in hand with the also savings, I think, from reinsurance premiums. So reinsurance premium actually reduced by approximately 21 mil. That brought us to net insurance service result negative 1.3. Main reasons, I think, other than the one-off effect of Tenang releases last year, I think the main reason was actually attributable to an increased motor weightage, I think, in the book, in the portfolio mix of the group. Investment income has been fairly stable. I think, as you understand, I think basically we moved towards a more conservative, I think, investment strategy. So we do foresee investment to remain stable. And insured result from Thailand's basically also stabilized. I think that delivered a marginal profit of 300,000, I think, for the quarter. If I move on to the next slide, retention, I think, is something that has already stabilized. I think during year-on-year 1Q24, retention increased by 82%. This may not be, I think, our key emphasis, I think, moving forward, because I think the issue of low retention generally has already been addressed with the exits from commercial business. We do see our retention ratio of our business actually stabilize at around a range of 80%, 82%. During the quarter, I think year-on-year, health actually increased by 5%, SME minus 5%. I think those are more seasonal, temporary fluctuations, I think, from Q to Q. We don't think that that is actually a trend that basically are triggering actually management's concern. Moving down to NWP, NWP We do observe positive double-digit growth, I think, across all key segments. Health grown by 13.8, predominantly contributed by foreign workers, highly profitable foreign workers business. Lifestyle actually grown by 22%. I think, as mentioned just now, motor actually outgrown, I think, the other segments by 21.6. Whereas travel continued to deliver double digits, I think, growth, I think, from travel recovery by approximately 17.5% year-on-year. SME also have actually recorded positive growth from both engineering and property. Next, I think zooming into combined ratio and all the key financial ratio during the quarter, first Q. Net income claims and attributable expenses ratio, you actually shown 20.9 percentage points increase. Predominantly, this is due to the MFRS 17's effect that our insurance revenue now actually represent gross earned revenue. So with the decision to exit from commercial, it actually reduced our insurance revenues number. When the denominator have reduction, there's a reduction in the denominator, the overall ratio would actually have shot up. In addition, of course, there's still going to be some impact, I think, from increased motor weightage, I think also to the overall business mix that actually have further increased our net income claims ratio. Acquisition cost has been actually stable or in absolute cost terms. However, because of the same reason of the exit from commercial, when insurance revenue reduced, when it's represented in terms of ratio, you will actually observe an increase in acquisition cost ratio. Reinsurance ratio, I think, same story. I think going back to the exit from commercial, that's actually giving us, I think, all these 13.6 percentage points of savings in our reinsurance cost in Q1 2024. Next slides on investments. We have actually maintained the same investment portfolio mix as well as strategies. Pretty much we have adopted a very stable and conservative investment strategy and portfolio with money market and deposit makes up 80% of our investments mix. And for the remaining 20%, basically we invested in fixed income funds through external funds managed by independent fund house. So we expect to maintain the current investment mix, I think, for the remaining of the year, of course, subject to unless there's any OPR movement, then potentially the investment committee may further deliberate, I think, on these investment strategies. Otherwise, the direction is still basically we opt for stable investment performance to be our main priorities, I think, for the rest of this year. Next slide, basically, I will pass it to Janet, I think, to run it through on our TPRs, I think, business and travel business growth.
Hi everyone, good evening. I'm Janet. Travel, I think we are expecting to continue to benefit from the travel rebound. As you can see, I think international travel last year, 2023, was at 88% of pre-pandemic levels, and it's expected to surpass the pre-COVID level in 2024. In Middle East, that's the only region who to overcome pre-pandemic levels with arrivals of 22% above 2019. Okay, in Asia Pacific, it's reached 65% of pre-pandemic levels, and it's expected to achieve a full recovery in 2025. Okay, for Air Asia Group and AAX Group, it's expected to expand its operational aircraft from 230 at the end of 2023 to 249. So basically, there's an increase of 8% by the end of 2024. And Air Asia will be expanding to India, China, Japan, and South Korea routes at capacity, leveraging on the strong demand and the visa-free arrangement. Okay, for Wetjet, it will also increase in terms of the aircraft, operational aircraft. It will increase from 2023 to 2024 by 17%. And in terms of the by 2024, it will focus on increasing routes to cities in their destination, which is in Japan, Australia, Laos, China, and Indonesia. Okay. As for Air Arabia, the operational aircraft is expected to increase by 11%. I think they're also expecting delivery of the Airbus 120 Airbus by 2025. Okay, and this year alone, they will be adding new routes for its operating hub in the UAE, Morocco, Egypt, and Pakistan. Okay, from our NTPR, we will be focusing on Vietjet. I think we are looking at activating the markets, Vietjet's high traffic international routes, offering travel insurance. We're working on, like we mentioned before, I think some of the destinations like Indonesia and India and Thailand. Okay. We will also look at activating hospital cashless admission. I think we launched that last year in Malaysia and Thailand. We'll be looking at launching that in three other markets in Q3. Okay. The team is also focusing on activating our offline agents and travel B2B in the ASEAN region. I think travel B2B is also new for this year. We have travel B2B in EMEA. And now the focus is on the ASEAN region. Okay, we will also continue to look out for new airline partners and OTAs to offer travel insurance solutions, and also some of the unique propositions we have, which is parametric solution, embedded insurance, and also one of the things that we are also doing, we're going round, the team is going round to our insurance partners across the region. A part of promoting travel insurance. They already have travel insurance with us. We are also cross-selling other products, other insurance products to them, the lifestyle insurance products. And we are also looking at their ecosystem, what's in their ecosystem, so that we can tap on it. Some of the IPs we have, they're bank back, some have telcos in the ecosystem. So we're working on some of these pipelines with them right now. Thank you.
Next, we will ask Jubin, I think, to run you through the motto strategies and plans.
Thanks, Al. Hi, good evening, everyone. Jubin here. So as you know, last year we embarked on our motor strategy where we wanted to grow motor selectively and certain preferred lines of business with certain channel partners. We haven't changed our strategy. I think it still continues. There are primarily 5 key initiatives that we are running within motor. So as Al mentioned, we have grown motor compared to last year over year, but it has been very selective growth and very targeted growth towards preferred segments that we feel where the loss ratios are lower and geographically where we feel that the losses are better. The first one is managing our motor claims. So there are 2 initiatives we are running. One is we are working on a frauds and claims prevention strategy with some of the key industry players, where we're trying to see how we can detect fraud and how we can seamlessly enhance the claims experience as we grow our motor business. The second is also looking at the portfolio mix with some of our channel partners, where we feel the mix is not up to the mark that we need, as well as the loss ratios are creeping up. We are trying to weed out some of those channel partners, and we're trying to get more profitable business from them. The second one is growing our preferred and profitable lines, which primarily have lower loss ratio. So as you know, in the market, the mid to high sum insured motor segment typically carries a lower loss ratio than less than 50,000, and that's a segment we've grown by almost close to 20% year over year. Our overall motorcycle premiums have also grown quite substantially compared to last year. And typically the motorcycle loss ratio is lower than the motor ratio, so we've seen 62% growth on that. With our key channel partner Post Malaysia, compared to first quarter last year, we've actually almost doubled our premiums and grown 100% plus. We've repriced certain key segments. We've had 2 rounds of repricing, and we continue to see more repricing happening in our strategy as well in the market, because the cost of spare parts has gone up, inflation has gone up, and premiums have generally increased on the market. So we continue to monitor the space and try and reprice even further. The last one is we managed to cross-sell and upsell a lot of our add-on products on top of our motor. So as you know, motor is with some of our channel partners is a key entry strategy for us, but then we try and cross-sell other products like travel, like PA, So our motor PA attachment rate, which is highly profitable, has increased from 29% first quarter last year to 39% this year. That's it on motor. Back to you, Hao.
Okay, thank you. Thanks, Ruben. Okay, on the next slide, okay, I understand basically there were quite a number of questions I think that we have received, I think from the analyst basically on with Rohit's departures, I think recently, I think a couple of weeks ago, basically what will be the new directions of the company or the group. First of all, I think I just like to assure that basically our strategy would not change, I think significantly, is because we will still have to follow the course of like what the board basically have endorsed, I think, for our key strategy over the next 3 years. But generally, I think there was some things in terms of our focus. Generally, I summarize into three big areas. In our next 3 years, basically, the key focus will be moving towards growing more international cross-country business through our reinsurance capacity and the insurance partners network that we have actually created over the years. I think as of now, basically, we have 45 insurance partners across 30 different markets. We do see that as a very valuable asset, I think, of the groups that the group actually could offer to support a lot of the cross MNC or cross countries, basically operators, be it actually from not just about servicing the airlines, for e-commerce companies, for example, hotel chains, etc. We do see ourselves basically well positioned in that, and over the next couple of years, that is going to be one of the key focus for our growth, driving the growth, I think, over the next 3 years. Fundamentally, we do see that there are a couple of areas that we have a competitive advantage, maybe over some of the competitors. I think one is basically our tech and our network in supporting this cross-regional or cross-countries business basically are already available, and then they are already in place to support our existing travel business. In addition, basically through the IPS network, we also can offer a more consistent customer experience, I think, to some of these players. Especially, I think we were in touch with maybe some of the online travel agencies. That is something that we see that we can offer as compared to maybe other competitors, which generally they have different experience from country to country. And lastly, of course, I think we are also looking at expanding our current global product offerings, basically which are already in place, I think, in some of the Middle East regions, and to try to bring some of these products over to the ASEAN's market. The second main areas of our focus, I think, will be actually focusing more on profitability, especially more on our general insurance business versus top line growth. So it's more balanced growth for our GI segments. That basically what we're going to be focusing on. The key changes also is going to be focusing a lot more on cost efficiencies. How actually can we drive economy of scales actually by offering some of the backend support functions centrally for the entire group. Also, we'll be focusing a lot more on return on investments to reprioritize some of the project and initiative of what we currently rolling out, I think, group-wide. This greater emphasis, I think, on profitable growth is to ensure that our BAU business or from the GI side basically remain basically self-sufficient. And that will also be aligned across all the management's KPIs in different companies as well as countries over the next couple of years. Thirdly, I think the group has also aligned, I think, that travel and travel ecosystem is going to be the next big bet and focus of the groups. We understand that basically our strength is actually with travel, and with COVID's recovery, travel is naturally, I think, one of the key strengths that we do foresee a huge growth potential in the whole regions. We will be more focusing on customer analytics, I think, to increase take-up rate through our various existing distribution channels. We currently have like 6 airline groups, and we do see the opportunities to grow in the areas, I think, remains, I think, a huge gap and potential for us. We will also be focusing on expanding other distribution channel, basically through travel ecosystem. When what we define as travel, it goes beyond airline. It involves travel agencies, online travel agencies like maybe Trip.com, Traveloka, hotel chains, cruise, event organizers. Basically, those are what we actually view as part and parcel of the whole travel ecosystems that we are actually quite well positioned to take advantage on these opportunities due to our wide, I think, IP or insurance partners network that we are readily able to support them. And these differentiations, I think, will the ability for us to demonstrate actually our take-up rate track records with our existing airline partners is something that we see to be an added advantage for us, I think, compared to our competitors, which generally are more in-country. And from our studies, they generally probably have a slightly lower take-up rate as compared to what we managed to demonstrate with our airline partners. Okay, for the next 3 years, 2024 to 2026, I think the target basically that's been approved by the board. Basically, we do expect to grow our NWP by double our NWP. Combined ratios target to be going down to 95%, and NWP per head house to basically maintain at double, I think, the amount at 1.4 million, I think, by year 2026. Yeah. With that, I think I'll summarize, I think, today's presentations. If there's any other questions, I think, from anyone in the call, yeah, you may raise now.
So we're going to move on to Q&A. You can unmute and speak.
Yeah, hi, Kevin here. Can I know how much is the travel